Well, we've got the Fed meeting out of the way, and relief has been sighed into financial markets with risk assets going on a bit of a tear, but we ask whether it can last. Obviously, with Trump tariffs due to kick in on a reciprocal basis on the 2nd of April, with tensions brewing in the Middle East and with US economic data clearly skewed towards the downside, it's hard to say that we're out of the woods, and buying risk with our ears pinned back seems like a tough trade at this point. Now, we are seeing a weak US dollar. It's finding few friends in the market, but potentially into reciprocal tariffs, we may see a reversal playing through. We are seeing gold and also copper on a rip-roaring trend, and we ask whether that can continue in earnest. And we also ask what's the trade in US equity indices. And we're also seeing a cheeky bit of life coming back into the crypto scene. Can it continue and manifest more broadly? These are the questions that we're asked in today's trade-off. I'm Chris Weston, head of research here at Pepperstone. So I was a bit put off by the fact we've got new music playing through. I didn't know about that. It's a surprise. Happy with it. It's very nice indeed. Anyway, I'm Chris Weston, head of research here at Pepperstone. I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics. We're going to be discussing all the factors that are going on in this crazy world of markets. Things are evolving at lightning speed. And of course, we're going to be watching what is the trade? Where is the propensity for the market to go? Where is the skew in risk and potential for volatility? Mr. Blake Morrow, were you surprised at that very upbeat sounding new music? It's wonderful.
I actually knew it from last week, Chris. Where were you last week or 2 weeks ago? 2 weeks ago.
I probably didn't have the sound on at the time. So I was in the office. That's why I was in the office.
That is the reason why.
I took a week off last week, so I'm feeling refreshed, sunning myself in Hamilton Island with the wife and the fam, and obviously recharged the battery. So good to go. I think
you got a nice tan going on.
Sun-kissed is the word, mate. Beautiful. But I was looking a bit red yesterday. I don't know if anyone saw my FOMC preview, but certainly looking a bit on the orange side as we do as Englishmen. But it's now manifested into something a little bit more of a golden glow, and looking good. Anyway, Blake, let's cut straight into it. Let's go into topical thunder and see what's going on in the world of markets. Well, we've just gone past the Fed meeting. We have seen some relief coming through. We've seen some buying playing through in treasuries. Yields are a little bit lower. We've seen about 6 extra basis points of cuts being priced into terminal Fed funds pricing. Gold continues going higher. The US dollar's sold off a little bit on the Fed meeting. It's difficult to trust this move because so often you see a situation where markets reprice. We had some of the hedging flows come out of the market, and then that first move doesn't necessarily last for a second day. But, I think the market has probably taken this one as less hawkish than feared. You can make an argument that there are very much hawkish elements in there. You've seen about 8 members of the Fed raising their estimates for the dot plot for this year. So they've only got 1 cut priced in or no cuts priced in. But the median dot has stayed at 3.875%. We go out further in the curve. The dot for next year in 2027 has remained unchanged. Actually, coincidentally, it's the first time since 2020 we've seen all the various dots, Fed fund projections, staying unchanged. So whilst the distribution has moved up, the median number has stayed. What I thought was interesting, Blake, also was the GDP forecast for this year have been taken down to 1.7%. I think that was kind of like expected. But the CPI or the core PCE numbers have been taken up to 2.8%. That was higher than sort of 2.6% the market was looking for. So that does feed into a more stagflationary environment, which I think is part of the reason why the US dollar has sold off. And we've taken a bit of solace from the fact that the Fed at the moment still feel like they're very much in control of their policy settings. They're happy to wait it out. They don't need to do too much. They feel like they're in control. We've taken some solace from that. They're looking through the near-term inflationary shocks that potentially comes from the tariff risk, and they've incorporated the tariff risk into their forecasts. But that stagflationary sort of dynamic, and also the fact that when you take the core PCE numbers up with an unchanged Fed funds estimate for this year, means that real rates have gone lower. The real policy settings are expected to be lower, and that's a positive for risk. So, all in all, we haven't seen anything that's materially changed. We have seen a change in quantitative tightening on the runoff for both bonds and mortgage-backed securities, but it's a gradual process as opposed to a firm hold. But how do you take the Fed meeting? Were you surprised by anything significantly? Do you think this relief we've seen can continue in earnest?
So A couple of things that stood out. So for the QT, the tapering of quantitative tightening, if you
Yeah.
will,
Yeah.
it went from, correct me if I'm wrong, 25 billion a month to 5 billion a month.
That's the MBS, isn't it? Yeah.
Okay, maybe that's what it was. So, so the QT didn't surprise you at all. I think what actually surprised the market, and I saw what stopped the market, is one of the very last comments that he made, that basically they're in no rush to lower rates. And when as soon as he said that, the dollar stopped its sell off, stock market stopped its rally, and but here we are in Asia, or early Asian trade anyway, and you're starting to see, the dollar pick up again and equities continue again. It's going to be interesting. When we look at the technicals, which we're going to obviously in a little bit, we start looking at, some of the other, what's happening in some of the other markets and some of the big breaks that we're seeing. It leads me to believe that there could be some continuation here, just because of some of the charts that we're going to show you, which I think are going to be very impactful for you guys.
Yeah, I think it's an interesting one. I mean, you can slice and dice it however way you want it, but at the end of the day, the price action is really what you want to watch. And I think if you look at the rates move, I think there was probably an element of people hedging against the possibility that we could have seen one rate cut being expressed in the dots, which would have required 6 members to take theirs. Who'd had called 50 to take theirs up. And so maybe, given that we didn't see that median dot pushed up, you probably could have seen some of the hedging flows taken up. So that's why I think this session ahead in US equity futures, rates, markets, bonds will be a much clearer and cleaner expression of how people see the Fed meeting.
Yeah, it's a good point. I mean, you're right. A lot of these hedges, downside hedges, got taken off. Maybe one of the reasons you could argue why equities popped there. But I don't know, overall, I mean, let's face it, Chris, the central bank is kind of like playing second fiddle right now to the bigger elephant in the room, which happens to be tariffs. But, that's going to take me to our next topic. I want to talk about the other central banks, because there are, believe it or not, other central banks that not only
other countries other than America as well.
There are, and I, as an American, I always laugh about it because I travel around the world quite a bit, and I have in my lifetime as an adult. And it's always interesting how the U.S. is and has been the center of attention, but I think that's waning, and I believe that that's waning, and it's going to continue to wane. And I'm saying that as an American, and I'm not necessarily bummed out about that. But for all intents and purposes, this week and actually tomorrow, we have the South African Central Bank, we have the Bank of England, we just got past the Bank of Japan. We got the Swiss National Bank, and I think that's it. If I've got my numbers correct, but there are some other central banks that are going to be meeting, and I think one of the more interesting ones is going to be the Swiss National Bank, because I still believe the Swissy is in play. If you remember a couple of weeks back, I talked about the Euro Swiss. I'm still very much playing that currency, even though I'm not in it right now. It's very much on my radar, and I've got orders all over the place to be involved in the Swiss national, or in the Swissy, or the Swiss franc. But with all these other central banks that are meeting, we got the Bank of England, tomorrow. Obviously, no changes expected, but the market is looking at maybe a potential more dovish slant with the Bank of England. We just came off the BOJ. You're going to talk about the yen. I think that poses a lot of interesting potential two-way price action, because the way the BOJ framed up the risks associated with tariffs and whatnot, even though obviously inflation continues to rise in the land of the sun, of the rising sun. And then you got like this. I'm not really following what's happening in the SARB this week, but with the South African Reserve Bank. But like I said, there are other central banks that could move the needle. Anything stick out for you?
Yeah, I mean, I think the Bank of England are they're not going to cut rates at the meeting this week, but they're in a sort of wait and hold situation. I mean, I think rates pricing one factor, and how will they show any kind of new urgency? I don't think that's going to be the case. We're still sort of thinking that maybe June could be a live meeting there, and factors play through. But I think the pound's a really interesting currency now. I mean, if you go and have a look at cable on a daily, you've had a nice move up from beginning of the year, 121 up to where we are at the moment, pushing 131. But we've come up into the sort of the November highs, and it does look like momentum's come out. So one for the scalpers into big levels at the moment. So the question, can this kick? And obviously there's an element of risk that associates with the pound. But we've now come up into this 131 level where we sold off pretty hard back in November. We're obviously looking to see if it can break, or whether this is the level that we want to look to fade into that. And obviously the dollar's a play there. I think that the yen's an interesting one. Obviously, we saw Oada coming out. He was pretty cautious on his stance. We do think, we're not going to see near-term rate hikes playing through from the Bank of Japan. And whether his element of caution is warranted. We've got 35 basis points of hikes priced for this year, which still seems about fair. But we've got wage negotiations going on. They look okay. The data's okay, and we still like the yen from. Go on.
I was going to say, doesn't it matters who he's paying off though to alter inflation expectation? Oop! Did I say that out loud? I'm so sorry.
You did. Yeah, I mean, I think there's all this Mar-a-Lago Accord and various factors playing into, but I think he's getting heavily leaned on. I mean, I still think, let's look at the currency effects, because I think dollar Swiss. You're talking about the Swiss bank. We've come into big support into 87.60. We've made a double bottom there. We had a bit of a rally come back. We're testing that. I think, pull up the daily chart of that, and we get a breakthrough through these lows. I think that's worth chasing. I think that that takes it down. Wouldn't be selling now. Again, let weakness come to you. Obviously, what happens with the Swiss National Bank and obviously the dollar side of the equation is very, very important. But we've hit big support levels now. We want to see that break. And then I guess the other one, we go back to dollar yen, because we'll talk about that in a second. We are working in a bear channel at the moment. I quite like selling this in at the moment. I think, if this kicks lower through yesterday's lows, I'll be looking to chase that lower as well. So it's hard to be a dollar bull at the moment. But if you look at cable, dollar Swiss, dollar yen, you've hit some big levels at the moment. And I think there's some good setups which need a bit of work, but I think there's going to be some really good opportunities in all of those pairs at the moment. Anyway, Blake, let's go to the US equity market, because, is this a tradable rally to chase? Are we out of the woods? I know you've got a chart list later on, so I don't want to let the cat out of the bag too much, but it's definitely worth talking about. We saw NVIDIA's GTC conference this week. I really liked what I heard from GTC, to be honest. I think, NVIDIA are doing everything right. They continue to do, I think, this. Do you want to go and buy this now and hold it for a period of time? I like it fundamentally longer term. I think valuation, not that you'd ever buy a NVIDIA on a valuation basis, but I like it at current levels. It just comes with massive risk ahead of export controls and all these other known unknowns that are playing through. But the NASDAQ at the moment is carving out of a range of 20,000, 19,200. I still quite like it trading in that range in the short term. I think a lot of the insto guys are holding certain stocks and doing call overrides, or effectively selling volatility and enhancing the alpha and the returns there on calls on those specific stocks. But you can see we're trading a bit of short-term range. I think it probably stays in that range at the moment, but I think when we see it break out, I think that's worth chasing. We've seen a bit of an upside move in small caps on the session. The junk end of town has had a bit of a rally. S&P, again, just trading, sort of consolidating. But where do you see the risk at the moment?
Well, I still see the risk is lower, and I had this long conversation with our community today, and I actually, if you listen to the recording, make sure you have kids around, put earmuffs on them, because I did drop the F-bomb, and I don't ever do that on talking publicly, and I just don't do it. But this time I did, and here's the thing, Chris. We have had this massive 180% rally since like the COVID lows. We're down 10%. All right, you just broad markets just say roughly. You can take other markets and say, well, this market's down this much, and broad markets down 10% correction. Pavlovian response for the market is to buy the dip, because we're going to go back to all-time highs. I think this time is different. This time is different to me, and you can see it in the price action. You can see it in the Mag 7. I don't trust this recovery that we're seeing. It's very shallow. It's very slow. I think it's setting up the stage for fresh lows, whether it's tomorrow or 2 weeks from now. I think that's the setup right now. So no, I'm not chasing it. There are certain levels that I am looking to be on the short side, which that's why you guys want to stick around to the end of this show, because one of my setups is going to be, or play of the day is actually going to be in the equity markets. So Chris, let's just skip on to
the way I'm looking at the S&P. I talked about the range on the NASDAQ, but the interesting thing, the S&P, or US 500 with Pepperstone is we've had this little bit of a move up from 5,500. And we've seen the last three candles, we've just sold off into basically into 5,700 on our cash market. And that's obviously a derivative of the futures pricing. So, yeah, we've just come up into 5,700 and we sold off. It's been capped at that level. That's where your risk is. So I know you're saying that you see the risk skewed to the downside, but I think, as traders, we adapt to the flows, we adapt to sentiment. I think, whilst I don't like buying risk, given that we've got these massive reciprocal tariffs due to kick in, Middle East tensions, data due to come down, we need to be open-minded, I think, to the idea that if we were to see an upside break of 5,700, it could kick. You just don't know, and I think that's worth chasing. So, how open-minded would you be to, an upside break of these highs and further moves coming? Which is it one you want to do in small size, just because the volatility is reasonably high and the risks are still there?
Well, actually, you know what, Chris? Without giving it all away, I'll show you exactly where I would actually turn bullish.
Okay, fine. Brilliant.
Yeah. Because I don't want to steal away from the charts.
And no swearing, mate. Just keep it. It's a family show.
I'm going to keep it clean. farts all day long. That's it.
Good man.
Blake doesn't give no farts. Okay. Anyway, so the last topic I want to bring up is actually, about some of these, risk assets or holdings, gold or crypto, and there's a big debate out there, Chris, and do you hold gold or do you hold crypto? And I can argue, and I want to, you guys got to stick around because we're going to pull up the gold chart, and gold's obviously at new all-time highs, and it looks pretty damn bullish. But the flip side is Bitcoin just cleared the 200 DMA today, and you're going to pull up the Bitcoin chart. I don't want to take away from that. The question that I wanted to ask you, Chris, is you got two assets with limited, perceived anyway, limited, supply. And there's a big push by central banks moving, out of dollars, let's say dollar reserves, into gold. You could argue that the Trump administration with the crypto reserve fund, their cryptocurrencies such as Bitcoin, maybe some other smaller coins might be part of that. Which one would you own at this stage in the game? And for me, maybe it's because I'm a dinosaur, because I'm over the age of 50, and because I still believe in paperweights, because I believe in paperweights. I'm a gold guy, but I'm not so much a Bitcoin guy. But I'm not poo-pooing on Bitcoin, because I think there's a lot to that story as well. I just kind of would rather own gold. How about you? What are your thoughts?
You're probably the sort of bloke who owns tie pins as well. You're thinking
I actually do own tie pins. I do. Yes, a lot of them actually. So
yeah. Look, as a trade, you're talking about how do I hold this as an investment or as a short-term trade, as per my trading strategy?
As an investment. Let's talk it as an investment.
Well, I think I think you can own both, personally, because the correlations are very low between the two right now. Bitcoin's probably trading more as a 3 times leverage NASDAQ ETF effectively, rather than gold. Gold is working. 2-year real rates have been moving lower. Central banks have been buying. We've seen migration of gold into COMEX vaults. Obviously, the scarcity in London's obviously there. We're now hedging against potential geopolitical risks with Israel and the US going after the Houthis in Iran, backed by Iran. Trump's now come out and said he's given Iran 2 months as a deadline, effectively, to sort their, to come out with their nuclear program and display that. And it's another deadline that could increase tensions between the US and Iran, which I think is something, again, which continues to move gold higher. Plus, you've got the momentum brewed, the CTAs and max long, and they've been building that. So for me, like when you're constructing portfolio allocation, correlations matter, because you don't want to buy two markets which are correlated, and they're doing two different things at the moment. So, I don't think you can spread the variance by buying both, and they've got different volatilities. Again, that can lower the variance in the portfolio. So I think there's a place for both, to be honest. But right now, as a trade, I love gold. I'll be buying pullbacks, but it's hot. It's too hot. But it is
too hot.
But I like Bitcoin. Again, I'm going to play this in play of the day. I think as a short-term trade, I think while it comes with real risk, given that we're talking about what's happening in the equity market, I say why buy equity when you can buy Bitcoin? It's more expensive from a spread perspective, but you're getting that for a spread per for what you get for the movement. I think it's very compelling. Holding costs are high relative to other markets, but for a trade, I think there's probably better upside in Bitcoin in the short term. But as a portfolio construction, I think there's a place for both for sure. I think gold does a lot of really good heavy lifting from a defensive positioning at the moment, whereas Bitcoin does the opposite. It's a very much aggressive alpha-seeking strategy there.
All right, good.
There we go.
Good answer. Right. Good answer, Chris.
Thanks, mate. Anyway, let's go to what is it? Trade of play of the day? No, let's go to that's a setup. All right, let's go dollar yen because we were chatting about this one earlier. Now, it has broken a little bit. Dollar yen has broken a little bit from what's going on in swaps and rates markets. But you are seeing still a pretty decent correlation with 2-year Treasury yields. But as you can see from the chart here, I mean, it's pretty basic stuff. But we've got this series of lower lows and lower highs. It's in a bear channel at the moment. We saw a move over 150. The market smacked it back down. You can see long wicks on the candle we've just seen. So obviously, anyone who's just recently last couple of days, people have been buying dollar yen on the hope of a more hawkish development and adding to the upside we've been seeing. They've been caught offside, so they've had to manage that position. Some of those would have taken off, and again, that's traded lower. So you've got this situation. We've got a long selling wick. You've seen good rejection of the upper parts of the channel, and prices closed below the 5-day exponential moving average. Now, what I want to see is the market come to me a little bit more here, Blake. I like selling stuff that's weak and momentum building rather than going out when things are sort of could be choppy. And I just want to increase the conviction in the trade. And the way you do that is just we're looking for it to kick below Wednesday's lows. And then I think this is where sort of sell stop orders work well. So the execution in the trade is really important. And so people say to me, "Oh, why would you sell something at a worse price?" Well, the whole point is based on sort of a momentum strategy that weakness breeds weakness, and that's why for me, I want to if this kicks below those lows and convincingly so, I'm in the trade. And I think you've got the rejection, you've got the long wick, you've got risk with being short dollars in a market that's already well short of US dollars. And it requires the market continuation of what we've been seeing in the Fed reactions. But I like this technically. I like this from a price action perspective. And just to increase the certainty and probability, I want to leave a sell stop order below the lows and hope that price can break through and kick on and trade down, hopefully down to the bottom end of that range.
All right, Chris, I like that chart. I'm seeing it the exact same way. And I love it when I'm seeing a chart just the same way you are. And as a trader, well, you know where your risk is. It's above today's highs.
Well, on a daily close above 150, I think I'd be probably looking to flip that position and looking to maybe even layer into longs as an aggressive tactical trade.
I don't disagree with you at all. All right. Well, maybe we're going to agree on the next chart, which happens to be my first setup, which is gold. This isn't the first time that we've shown this channel in gold on this show. But this time we're actually breaking above channel resistance. We closed above channel resistance. We closed above 161% extension. We are in what I like to call an acceleration phase in gold. It could be, and that's why this is a setup. This is one of those that if you're short gold, you're probably quite concerned. If you're long gold, you're happy. That doesn't mean that it's going to stay this way. What you want to see is consecutive closes above 30.50. Then it starts building the case. And you've seen it, Chris, and you've been in markets. And I'm not sure if gold could be that market, but it sure has the potential here where you just start looking at round numbers. Because we have no extensions to look for, we have no real levels to look at. That's when you start going, okay, next target, 3,100. Next target, 3,200. Next target, 3,300. If we keep this up this pace, it is going to get in an acceleration move. And if you look towards the middle of the chart, you can see what RSI looks like when it's really overbought. We're not there yet, not even close.
Yeah, so, what do you think of the risk here of getting divergence playing through in a market that's obviously very, very long of gold at the moment? You can see the RSI. Is there a risk of divergence kicking in, which gives you a bit of a flush out of those long positions?
That's why yeah, exactly. And that's why, yeah, back below 3,000, you're wrong. And that's why it's a setup, because if it breaks back below 3,000, you got what we call is a throw over, which is a false breakout of a channel. And that means that we would reverse, more than likely coming back towards the bottom end of that channel, if not breaking it completely. So that's why it's a setup.
Yeah, exactly. So you've got a confluence of factors. Top end of channel, you've got potential divergence in place, and market positioning that's obviously very saturated in risk. And look, our clients have been trying to sell this now. I mean, they're very, very short of gold, long of US dollars. Maybe they're seeing the risks clearly skewed to the downside. But I think it really depends on who you are as a trader. I mean, if you're a swing trader, you're probably looking to buy pullbacks in this obviously very positive market. You might take some off the table at these levels, look to buy weakness and hope for another swing higher and a higher high in that situation. And of course, you've got probably the scalpers who are looking to fade into these levels as a quick one, and then maybe people looking to do a bit of mean reversion as well. So it really depends on your strategy. I think there's probably something in this setup for everyone in that capacity. It's going to be interesting to see how it plays out, but I wouldn't be necessarily layering into new longs at this point. See. Let's see copper, because it doesn't get the same sort of love as gold, but it's on fire, right? It's absolutely on fire at the moment. It's under the radar. Now, this is one that I would be looking to chase on a little bit of a pullback back to about $5 a pound. It's doing everything I want, right? It's in beast mode at the moment. You've got this impulsive move up. It's every sell-off into the 5-day exponential is being bought and hoovered up. You can talk about China. There's signs of increased buying coming through there. We're seeing a range of upgrades to GDP forecasts in China. China's obviously a risk at the moment because trade tariffs are going to kick in hard on the 2nd of April. It'll be interesting to see if they lower them on a reciprocal basis. But I think there's an element of risk around China. But what we're seeing now is consumption of copper building up there, and there's a lot of people playing the basic the LME. COMEX copper divergent trade and the arb between the two. And if you look at the CME premium of copper relative to LME copper, it's blown right out. And I think that's a reflection of tariffs. People are saying that Trump's trying to push through these 232 executive orders, which means that potentially he could put tariffs on copper imports, essentially seeing this as a strategically important commodity going forward. We'll see if that gets passed. But the market is front running the idea that possibly it could put a tariff on copper. People are pulling their copper over to the CME, and you're seeing that arb blow right out. And again, that's pushing this up. So there's an element of China buying. There's an element of this arb that's taking place. And then you've got this other factor, which is the CTAs who are max long at the moment. They've been buying into futures and copper futures, and that's propelled the price. So, how far can this go? Well, the art of trend following, the art of momentum trading following is not to question where it can go. It's just to hold on to the point that the market spits you out and you get your systematic rules kicking you out. So you don't trade with price targets. You just let it ride. You're trying to get it up until the market spits you out, and you've got to chase. You've got to have that risk, that exit strategy, which follows the market higher. So this is in beast mode. It has to be on the radar at the moment.
That is on the radar. And I, frankly, just looking at the technicals myself, it looks like 510 is as doable here.
Yeah, we see it pretty much at the moment on our cash market. So question how far it can go.
Yeah, no kidding. And and I do defer to you to these momentum type of strategies. You're much better at that than myself. I tend to be a revert to the mean or buy. I need a meaningful pullback to get in. But man, when these things go, they go. So
it's interesting. You think on these strategies, you can use a basic moving average, a moving average crossover, an ATR trailing stop loss. You can use counterband. You can use 20-day or 45-day lows, and trail it up depending on your time frames and various factors there as well. So, I think in this situation, you need to stay unemotional. When you see a trade like that, let's say you got in at so you got the breakout at 475. There's a lot of retail traders who'd be sitting there right now going, "Oh, I'm in massive profits. I'm going to surrender the profits. What happens if it rolls over?" That's not how to think. You've got to stay in the trade and being unemotional. That you've got to have that systematic stop. So that's why I like to use something really basic like prior 30 trailing prior low, an ATR stop loss, or using a moving average crossover, or even just a generic moving average just to if price closes below it. So that's how you stay unemotional, and you let these big kickers run, and you don't use your discretion.
Smaller positions, wider stops, the Westy style. I like it.
All right.
All right. All right. So speaking of something that's kind of kicking in a kind of just a little, we're going to take it over to my second setup, which is the euro dollar. But I had to zoom way the hell out. So do you remember? Do you remember when Giselle said, "I only wanted to get paid in euros"?
Yeah, it was.
Um,
We talked about it at the time. It literally marked the top.
Yeah, it did. It literally marked the top of that chart. Near 160, it was probably like 157 or so when she said, I only want to get paid in euros. Anyway, great times those were. And since then, the euro's gone straight down. And we're at a point, and I will be the first one to say, and I know we've talked about this over the last couple of weeks. This is a big deal. The euro, I think, is going higher than it is right now. Over time, I think it's going to be trading in the 115, 120. We can see what happens, once we get up there and what the European / US situation looks like. But I believe this is that big of a deal, and I think the euro is going to eventually breach that descending trend line. That descending trend line comes in right around 111. So I wanted to bring it to your attention because that's like the last Fibonacci also that we see in the euro. It comes in right at, it's the 88% retracement. And you'll see that little it's in teal. It says the inverted head and shoulder pattern. You remember that from 3 weeks ago, we were saying, oh, there's a base. And then I didn't expect it to rally the way that it did. And it did. And I mean, it took off like a bat out of hell. So we're getting close to that 111 level. I think that's where you're going to start to see a lot of two-way price action. I will be a seller up there if we see it, just to see how we react. But ultimately, I do think it's going higher, Chris, and that's why I thought I'd bring it to your attention, because if we break 111, we're probably going to see 115, by Q2. Or
How much has euro dollar been an absolute case study this year of having an open mind?
yeah,
We started January, people were talking about the probability of parity, and it was a big consensus trade that it was going downtown because of tariff risk. And now, pretty much every sell side has got a positive view on euro dollar. They're talking 110 plus, 115. The idea that the US growth, you're seeing stagflationary and type dynamics playing through in the Fed's SCPs, and although Jay Powell's pretty quick to say there's still a low risk of that happening. But what we're seeing is US growth rates are being taken down. There's going to be downside risk to future payrolls numbers, whereas European growth rates are being taken up. They're still pretty anemic, and we're going to be watching those PMIs on Monday. I think they could be quite interesting. But it has now become almost a bit of a consensus trade to be buying dips in euro dollar, and the path of least resistance over time now is higher. Yeah. But again, it just comes into this idea of just having an open mind. Everyone was thinking parity was going to have. Well, a lot of people were thinking parity at the beginning of the year. Now everyone's bullish, and things have changed. But I still think there's a lot of people out there who disagree with this idea that euro dollar is going higher, and if they were to buy it, they're going to hate themselves for doing so.
Yeah, and I agree with you. And I mean, hell, people were calling parity the morning. I was seeing gurus, I call them gurus, that were calling euro parity just before that German announcement came out, and it was a huge. And we were sitting in our community going, "Oh my God, did they just really just announce that? Drop everything. We got to buy euros." I mean, but that's how the markets can change just on one thing. And
we've got the fiscal vote coming through. I mean, we've had it through the Bundestag, and that got through fairly comfortably. I think what's the other one? The Bundesrat, so that's got to go through the other part of the house, and that should pass. But I think it's a big deal, from a semantics perspective, you are seeing a closer ties. But we'll see what happens with tariff. The interesting thing with tariffs on a reciprocal basis, though, Blake, everyone's seeing it as the doomsday scenario. Trump's bigged this up as a major announcement. $3 trillion in income they're going to get or so. But what happens if we were to see, from a reciprocal basis, the Europeans and other nations actually lower their tariff rates in this period of negotiation, saying, what, we do have higher tariffs than you do in the US, and maybe we'll take ours down and appeal that in that, and there can be an agreement. If tariffs come down, we're not taking into consideration the VAT side of things, but if tariff comes down on a reciprocal basis, does that increase the actual trade flows and increase global trade? I mean, that could be a positive scenario to think about.
That's something really to be thinking about, something we're going to be dicing. And that's why I think, as we approach that 111, 110, 111 level, we're gonna see a lot of action around there. Two-way, which is good. You know, as traders, it's what we look for.
Exactly. Anyway, let's go to play of the day. I got that one right, so I'm feeling good about my life right now. But I'm going to be going into something that does carry a bit of risk, and let's go to Bitcoin. Now, we have seen some love in the crypto scene overnight. There was buying going into the Fed meeting, certainly in Ripple. I think there's been some developments on an SEC basis where they've cut back on their investigations there, and Ripple had a nice move, although the technical daily chart still looks it still looks a bit precarious. But I think with Bitcoin, at the moment you've seen these really strong buying coming back into sort of 77,000, just above that level. Strong wicks. There's been good demand to play through, and what we've seen now is after this little bit of a period of consolidation with higher lows, is that the market has pushed itself a little bit higher. Now, I'm long. Very, very small size, because what we're doing is in this risk assets, you just got to take the view that the market is standing up and it looks good. I like what I'm seeing. Again, this could be sort of correlated with if the S&P futures with S&P chart that I showed you earlier, if that was to break 5,700, NASDAQ gets into top end of the range, potentially breaks 20,000. I'm skeptical but open-minded to that idea. Then that high beta asset that is Bitcoin will outperform. You're going to get bigger percentage moves. It's more expensive to trade, but you do get a more for the spread to potential range. I think it's still good there. But I like what I'm seeing from a price action perspective. The bulls are stepping up. They're taking control. Can this kick? No idea. But I think the probabilities are that it's worth the risk at the moment. Look, I will be looking to cut out below Wednesday's or Tuesday's lows and looking to cut there. So there's a little bit of risk I'm taking in the position, but I'm looking to hold this one. Potentially, I don't know, to be honest, but I think it's got potential. If it does kick up into 92,000, that kind of area, I'll wait. But I like what I'm seeing. It does feel that the bulls are stepping up and that probability distribution is shifting enough to give that trade.
All right. Chris, I think 90,000 is quite possible, to be honest. So, hey, I like it. All right. So this is the S&P. It's going to be my play of the day, and I am looking to play it on the short side. Obviously, I've already alluded to that. I took us down to a 4-hour chart to give you guys a very close-up view of this chart. Now, since my week ahead video, our prep video that we do every week, I've been talking about a bear flag pattern. It's turned more into a pennant just because the lower band is not as parallel to the upper band of that channel or the flag portion of it. Anyway, that leaves the door open for every time we rally and we get into these highs, these levels to be sold. Now, 5,700 is the level, Chris, you're looking at. The level that I care about right now is the 38% retracement, which comes in at 57.52 on the Pepperstone CFD. That's what I'm drawing this chart on. That's what I'm looking at regarding this chart. As long as we stay below the 38% retracement, that means that when you have a flag pattern, they're continuation patterns. And the way it's going to be a continuation pattern is if it stays around the 38% retracement or lower. Obviously you can get to 40% retracement, but right around that level, as long as you stay somewhere around there and you get daily closes below that, that means the continuation pattern to the downside is quite high. Those where the risks are. So if you asked me earlier, which you did, you're like, well, where would I get bullish? Above 5750, I think we can test 5900 again. So that's where I would say, all right, I was wrong, and I don't mind being wrong. I just got to know where I'm wrong, and that's it.
Yeah, right. Well, do reach out to Blake if you want to get in touch about finding out about his weekend videos or getting some of his research with being a Forex analytics client. It's worth doing.
Thank you.
Yeah, there you go. But certainly when you're getting this sort of information, if you're into technicals, and I think they're probably a great way to look at the markets at the moment and understand the probabilities. Do reach out to Blake. But anyway, thank you everyone. Thank you, Blake, for your thoughts today, and for you guys and girls at home for sticking around. We'll see you back next week for more of the trade-off.